and a very warm welcome to all of you for joining this discussion on our financial and operational performance for the fourth quarter and full year ended March 2024. I do hope you have gone through our results, the investor presentation, and the earnings release, which are available on our website as well as the stock exchanges today. For this call, I welcome you all and my team who will join me to answer your queries and update you on our performance across the business. I have with me Yogesh Gupta, the CFO, Vineet Pant, the Chief Commercial Officer, Mr. Kalpesh from Hydro, and Mr. Stuart Corner, who is representing the promoter today. I will address the global economic environment. In 2023, the global markets showed unexpected strength despite higher central bank rates and slow trade growth. Surprisingly, several countries, including the U.S., achieved modest economic expansion despite these hurdles. However, ongoing worries about high debt levels and geopolitical tensions are expected to limit global growth prospects for a year. The World Bank's forecast for a global growth slowing down to 2.4% in 2024 marks a deceleration for the third consecutive year, primarily attributed to the lasting effects of tight monetary policies adopted by both advanced and emerging economies. Notably, trade growth in 2023 witnessed its slowest pace outside of global recessions in the past 5 decades, indicating a challenging environment for global economic expansion. Amidst this cautious backdrop, India stands out. The country's growth story is fueled by investments in infrastructure, strong consumer trends, and positive investor sentiment that continues to attract foreign capital. India's well-managed inflation rates, coupled with expectations of monetary policy easing further, strengthen its growth trajectory, promising a healthier financial landscape. While the World Bank predicts a slowdown in private consumption growth post-pandemic, this is unlikely to derail India's overall growth momentum. It's essential to highlight India's upcoming political transition as well, where the anticipation of a new government comes against a backdrop of remarkable political stability at the national level. This stability significantly contributes to investor confidence in India's growth, painting a bright future for the country's economic future. Talking about the Indian power sector, in the energy sector, we are observing a positive trend with energy demand showcasing a 7% growth for the second consecutive quarter, reaching a peak demand of 240 gigawatt last year. Our country's overall power generation surged to about 1,700 billion units in 23-24, with nearly 76% of this demand coming from thermal, underscoring its pivotal role in India's power mix. As power demand rises, government is prioritizing the optimal operation of thermal power plants, even if it means higher dependence on imported coal. Additionally, there's a focus on enhancing the efficiency of older power plants to ensure they can meet electricity demand during peak periods. Yet we confront a dual challenge within the energy sector stemming from divergent demands. There's critical imperative to escalate renewable energy capacity at the same time. According to data from IEA, with rapidly expanding economy and heightened electrification, India is projected to experience a 6.5% annual growth in electricity demand between 24 and 26. India is poised to achieve fastest growth rate among major economies, adding demand equivalent to that of the United Kingdom over the next 3 years. In response to the increasing electricity demand and rising coal requirements, India has made significant strides in ramping up coal production in the recent years. Over the past 4 years, there is a CAGR of 8% in coal production, with a notable 11.65% increase recorded in FY2024, according to data from Ministry of Coal. The ministry reports that coal production nearly reached 1 billion tons, standing at 997 odd million metric tons compared to previous year of 890 odd million metric tons. Additionally, they have observed a rise in coal imports, with the country's imports growing by 7.2% to reach 244 million metric tons in the April-February period of FY24, up from 227 million metric tons in the corresponding period of previous year. These developments reflect the ongoing efforts to meet the nation's energy demand and ensure a stable energy supply for India's growth and development. The data for FGD technology, where we see the government deadline for implementing the FGD for thermal power plants, is fast approaching. However, we see slower than anticipated flow of orders over the past 2 quarters. With only a few months remaining to the deadline and considering the time required for system erection and the implementation of the FGD norm looks challenging, and we will watch this sector very closely. That has an impact on the market for your company. I would like to now touch upon the financial condition of the company and the strategic focus areas of the company. You may refer to page 17 of the deck that we shared today. The company's balance sheet has deteriorated significantly due to major project cost updates and incidents like Sipat Solapur fire, etc., and lower order intake in the prior years. The net worth of the company has come down to almost 57 crores as of March 2024 from 226 crores in March 2023, and the company has been making losses for 3 consecutive years. Thus, the balance sheet of the company is stressed. Please refer page 16. The company is totally dependent on working capital, funded and non-funded limits on the promoter. Attracting working capital from banks without promoter support is challenging for JEPL. The company's ability to pursue coal-fired thermal projects would need support from a new promoter subject to depromoterization. Therefore, JEPL will continue to focus on following business areas which are supported and aligned with the promoter. The business areas that the company will continue to focus on is the services, which includes the core services and service upgrades for the power plants. The company will continue to focus on brownfield FGD on EP basis. The additional area that we have been talking for several quarters is the Durgapur factory utilization, where we are focusing on services. We will continue to add additional equipment supply for pressure vessels and cryogenic applications. On the hydro market, we continue to focus on services and selectively on cash accretive, margin accretive PSP projects, and we will see how the market shapes up. So these are the strategic focus areas that the company will work on a business plan to make sure that it has a sustainable business plan for the company. This will be lower in volume from the reference point of where we are today, but it will have the right risk-reward ratio for the company. For the last few years, we have been sharing the progress of the company's progress on the strategic areas, quarter on quarter in the categories of new build versus services, EPC versus non-EPC, and industrial versus government. While we are happy to see the progress on de-risking the balance sheet and the growth in services in the quarters, and especially with service growth, which has been quarter on quarter double digit for several quarters now. However, now the reporting we will change from these segments to the areas that I have mentioned previously in our strategic growth, that is the services growth, the brownfield FGD equipment, the Durgapur factory utilization, and hydro selective participation. So those segments is what we will report to give you progress on how we develop quarter on quarter in the coming quarters from July. So having now touched upon the strategy, I would now move to the executive summary for the results for which we have gathered here today for the quarter 4 and also for the FY24 for GE Power India. In the fourth quarter of the financial year 23-24, we continue to see that FGD and hydro opportunities have converted slower than anticipated. On the other hand, the service business witnessed a very strong quarter, due to which our revenue has also gone up by 14% versus the quarter of previous year. This quarter witnessed a positive impact on profit from the claims, including insurance recovery, totaling to about 70 crores. Overall, FY23-24 year saw a decline in orders by 20 years over the previous year due to lower order intake in hydro and delay in FGD ordering, which impacted and reduced the backlog, and therefore we consume backlog and the revenue is lower by about 10%. The core services continue to grow 40% with an upswing in upgrade orders, which include major DeNOx deals like Hindustan Zinc and Naitan Power Limited. Overall, there is an improvement in profit year-on-year due to a one-time positive impact on insurance and claim recoveries. So that's the overall summary of the financial performance of the company. I would hand over to Yogesh, who will take you through the details of the performance of the quarter and the year. Over to you, Yogesh.
Thank you, Prashant. Good evening, everyone. I am pleased to welcome you all for sharing the financial and operational performance of JEPIL for the fourth quarter ended 31st March 2024 and the full financial year of 2023-24. During the quarter, the company booked orders worth 262 crores against rupees 228 crores in Q4 of FY22-23. This is 15% higher in the current quarter. During the financial year, the company booked orders worth 1,319 crores against 1,635 crores booked in FY22-23. This is 19% lower in the current financial year. The slower than anticipated order flow from FGD and hydro pump storage projects has impacted revenue. The backlog thus has depleted from 3,615 crores as of March 23 to rupees 3,437 crores as of December 23, and further went down to rupees 3,309 crores as of March 24. Revenue for quarter 4-24 stood at 391 crores, up from rupees 344 crores in the corresponding quarter of last year. This is 13.5% growth or increase vis-a-vis the last quarter. The revenue in Q4-24 is lower than the revenue of 456 crores in Q3-24. Lower than expected order intake in the last few years and the Samruddhi project suspension has resulted into lower revenue for the financial year. Revenue in FY24 stood at rupees 1,625 crores, down from rupees 1,796 crores in FY23. This is 9.5% lower in the current financial year. Cost escalations due to project delays, execution challenges at site, and slower claim conversion have led to the lower margin for the current quarter, which was compensated by one-time positive impact of recoveries from claims, which included the insurance claims. Profit before tax for Q4-24 was 23 crores against the loss before tax for Q4-23 of rupees 128 crores. Further, the loss before tax in FY24 stood at rupees 177 crores against the loss before tax of rupees 324 crores in FY23. The reduced loss is due to one-time positive impact of insurance and customer claims as stated above. Summarizing, focus areas for the company continues to be claim settlement and cash collections by timely execution of the projects. This is it from my side. We are now open for the question answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Madan Gopal from Sundaram Alternates. Please go ahead.
Good evening, sir. Are you able to hear me?
Yes, sir, you're audible. Please go ahead.
Sir, just wanted to understand, given that the coal-based boiler turbine generator market is picking up momentum now, given the government's renewed thrust on coal-based capacity addition, Alstom had been present in this. We used to even support BHL, but of late we are out of the market. We are not getting new orders. How are we seeing that opportunity, given that the pipeline looks strong? Are we planning to re-enter this market? How are we looking at it? Because there is a 10,000 megawatt of ordering that can happen this year as well. This is my first question.
Thank you for the question. As I have mentioned earlier, the current situation of the balance sheet of the company requires that we rely on the promoter for support on parent company guarantee for issuing bank guarantees of the company, and the promoter has exit worldwide from new coal. And therefore, in the current context, for the company to be able to participate in new coal would only be subject to a new promoter or depromoterization, where we have a new promoter backing the balance sheet to be able to participate in this market, because this market requires bonds and bank guarantees, which requires working capital, both funded and non-funded limits, and the current balance sheet of the company by itself cannot support this opportunity.
Okay. Second, on FGD opportunity, now that it has been delayed, you think the ordering can improve starting from 2024, FY25 or FY26? So how do you see that ordering panning out? Is it likely to be delayed further? So how do we see that?
So I think I'll take that question. So as far as the FGD ordering is concerned, yes, it has been delayed, and as we mentioned, we don't see the installation will take place as per the timelines. But having said that, in the last year, about 17 gigawatt has been ordered, and it's mainly state utilities and some private utilities, private customers. So I think going forward, I think it's still going to improve. It's not going to be massive change, but going forward, it is going to pick up. Not like what it was there maybe 3-4 years back, but ordering is going to be staggered, let's say. It's not going to happen very quickly in the next 2 years, but it's going to be spread over maybe 4 to 5 years.
So what we would want to make sure is we follow the regulations closely, because the government had extended the deadline, and now that the deadline is approaching, maybe the market is still expecting, based on the IIT report, that there might be a further extension of deadline. So therefore, there is ordering, but it is not as per our expectation yet. And for the amount of FGD that still needs to be installed, we don't see any way practical now that it will happen before the deadline. So it is going to be subject to the government regulations on whether they extend the deadlines again by a year, 2 years, 3 years. This is something we need to monitor very closely. Since this is again regulated, the market is really dependent on the customer's decision whether they want to continue and invest. So we are seeing some customers moving forward with the tenders, but we don't see all of them yet moving forward, and that is where I think the regulatory aspect brings in the uncertainty on forecasting a property demand.
Okay. My last question is on PSP projects. A lot of talk about it. The pipeline is also building up. But do you think any possibility of any of the large orders getting converted this year? And who are the competitors here? You and BHL, right? Is there any other player who are serious in this space?
So, look, regarding the hydro, what we have been seeing, we were very, very bullish 2 years ago when we saw the entire landscape. However, what we have seen is, again, despite having closed an order about almost 1.5 years ago, we have seen that the order was in the suspension. So the challenge that we see in the portfolio, if I have to say what we are trying to solve and what we are reporting quarter on quarter, every quarter for many quarters now, is the company has 3 categories of projects. One is the hydro projects. Whatever we might say, we have current backlog which is spanning over almost a decade plus, and we still have old projects in the backlog, and we still see project delays which are spanning over decades. So it's a very long gestation cycle, and therefore the highest risk in the portfolio, which has a big impact quarter on quarter to be able to forecast it as stable revenue. The second category was the EPC FGD projects that we have been taking. Those projects are spanning around 5 to 7 years. Currently, we have been able to de-risk that with EP participation, where we are going into a category of 3 to 5 year extension and conversion into margin cash. We think we are making progress there to de-risk quarter-on-quarter performance. However, the market has still not shaped where we would expect it to be. The third area is the industrial business and the services, where we see quicker, faster turnaround into cash. And this has been the biggest area of focus for the company, where we see services in the core services, the cash conversion happens pretty much in the same year. And we have been reporting almost 10% or double-digit plus growth consistently quarter on quarter for several quarters. And the year that ended, we have grown by about 40% in the core services. The upgrade is an area that we saw no orders literally for the last 3 to 4 years. But in the last financial year, we have seen an improvement in demand in the upgrades, and we have seen and booked several upgrades, especially the DNOX job sites, which I mentioned about briefly previously. So if I look at the portfolio and our focus, the focus is to de-risk and bring quarter-on-quarter stable revenue that is generating profit and cash for the company. The large projects are creating distraction. It is difficult to forecast and balance both the working capital requirements and also to maintain sustainable quarter-on-quarter performance. And therefore, every quarter we have been sharing our progress on these 3 pillars. How can we de-risk the EPC patchiness? That is one quarterly, you can see that is also in the deck today. The second was to grow services, where we are reporting for several consistent quarters and quarters how are we progressing. And the third was the industrial customers, how we are able to increase our participation in the new tenders towards industrial customers that will help us bring in stable quarterly revenue cash. So that's the biggest focus of the company, to bring stable revenue margin and profit in quarter on quarter into the company, and plan for the right strategy that delivers that. Unfortunately, since we had these large orders which were forecasted but got delayed, or the large orders that we booked but we were not able to execute, especially in hydro, the revenues have been lower than anticipated for last couple of years. And I've also said this in the previous investor calls, and I'm repeating that today, that the turning around in the revenue to positive is taking longer than anticipated and will still take several quarters operationally, because we are not able to come back to a profitable revenue quarter on quarter because of the patchiness of these large projects. So that is the challenge that we are working with the company. Hydro, yes, we had anticipated a lot more orders, but they've not moved as per our expectation. Kalpesh is here with me on the call, and maybe Kalpesh, you want to add on the hydro specifically?
No, Prashant, I think you covered very well, and I think just I want to add is like, even the new opportunities, there are a lot of permitting and other regulatory approvals requirement, which also takes time to convert it in the real order case. So yes, there is lot of noise in the market, but it takes time to get it into the real order.
Thank you.
Thank you, Kalpesh.
Mr. Madan Gopal, may we request that you return to the question queue, please? The next question is from the line of... Before we take the next question, a reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Ahmed Madha from Unifi Capital. Please go ahead.
Good afternoon. Am I audible?
Yes, sir. Please go ahead.
Yeah. Thank you, sir. Thanks for the opportunity. So I just wanted to understand, what's going on the FGD side, and what is the delay, and can you give the timeline whether when will it start again?
So FGD is not stopped. All we are saying is that the ordering is taking time and it is not spaced out as we would have expected. So it's the government regulations for being compliant that everybody is adding FGDs. So Vinny, would you want to give a gist on the market opportunity?
And so I can just add here, just to answer to your question, as Prashant said, it's not that ordering has stopped, as I mentioned earlier in the call. Last year about 17 gigawatt was ordered, and the year before about 20 gigawatt was ordered. So it's not that the ordering has stopped, but it's not happening at the same pace, Presently about 128 gigawatt has been ordered. This will be around in 6 to 7 years. But what is left is still a very big, it's about 96 gigawatt. So point is that, 96 gigawatt, if it has to be completed within the timeline, it's really not going to happen. So what we are saying is that, it is going to get staggered, the ordering. So roughly we see about 20-25 gigawatt will be ordered every year. That's all. But ordering will take place, but in a staggered fashion.
And we have seen one order in the current quarter which we have reported to the exchange of JP, and that notification is in public domain. You can refer to that. So we have disclosed that, Vinny?
Yeah, we have disclosed that. So that order we have booked from JP. It is for the Bina and the Nigri plants. And as we were talking about, it's going to be on an EP basis. We are going to do the complete supply of the FGD equipment. And erection and civil is excluded from our scope. And the value is about 775 crores. So this is what we have booked in this quarter.
To explain what is the dynamic that we are talking about is though we have this order, the typical conversion time for this into revenue takes several quarters. The first 3-6 months it all goes into engineering. It's not a lot of revenue. And then we have basic supplies, and usually 12 to 18 months is where we start seeing the peak of the revenue. And therefore, when I said previously, and also in my previous earnings call, the quarterly operational performance of the company to turn around will take longer than anticipated by the time we reach this right mix of volume versus backlog versus cost. So that's what we are working and working towards as the part of the strategy that we have shared today.
Oh, okay. That was very helpful. And another thing, as far as I understand, there was 211 gigawatt to be installed by 2026, out of which around 110 gigawatt has already been awarded. Bids have already been awarded. So can you give a sense of which players have received these orders, and out of as given the delay in the project, out of the remaining capacities, how much market share can we capture from?
See, what has been ordered is around 128 gigawatt, and the major players have been BHL, L&T, GE, MHPS, ISJEC. So these have been the major players. And what is remaining is about 96 gigawatt, which is to be ordered. So that is what is remaining right now.
And when we are going
I don't want to give an exact number, but we today, as we mentioned earlier, in the last years, we have been quoting on a full EPC basis, but now we are going to focus. These projects are more towards state utility customers. What is left, state utility and the private players. So we are going to focus on cash accretive deals and on EP deals. So it's going to be factored accordingly.
Okay, so like right now you can't give a number on how much.
So I really don't want to give a number at this stage.
Okay. And for the JP contract, if I'm not wrong, it was around 750 crores for 2 gigawatt installation. So assuming that per gigawatt, the market size will be around 375 crores, right?
Yeah, so I think the market, what we have seen is what has been ordered, 128 gigawatt is roughly around 60,000 crores. That is what has been ordered. But, prices have gone up and, so roughly we were talking about 60,000 crores. That is what is the estimate of the total market, which is left to be ordered.
Thank you. Mr. Ahmed, may we request that you return to the question queue for any follow-up questions?
Yeah, sure.
The next question is from the line of Bharat Sheth from Quest Investment. Please go ahead.
Hi, thank you for the opportunity, sir. Sir, can you give little more color on the nature of the services and the competitive landscape and the total available market as well as for the industrial also?
Yeah, sure. So when we say services, we are talking about the thermal services, which is core services. The core services entail parts, spare part supply for the entire power plant, which is steam turbine, boiler, generator, air quality control systems, and automation and control. So across the thermal power plant, that is what we say when we say core services. If it's an R&M or retrofit and modernization or an upgrade, that is where we have to upgrade the performance of an existing thermal power plant, either for efficiency or availability or emissions. So that falls into the category of upgrades. So that is the two categories of service segment that we are focusing on. As a part of our strategy for the last couple of years, we have significantly focused on core services quarter on quarter because this converts into cash and margin typically within 6 months and is very positive for the company, and therefore that's the focus area of the company. In terms of market sizing for core services and upgrades, Virit, please provide more color to that.
Yeah. So the market, we are looking, the annual market, typically we are looking at about 5,000 crores. That is the number which we are estimating.
And competitive landscape, yes, sorry.
Competitiveness, I would say, we are, we have the, if you talk about core services, we have the other OEM fleet and we have the OEM fleet. There is and on the other OEM fleet, of course, it's on a tender basis, so we have to compete. It's going to be on a tender basis, open tender basis. So I think there I think we are working. We are competitive. We have been increasing our market share in the last few years. So I think we have a competitive offering for both core services and upgrades.
So maybe I can add more color to that very quickly. The benefit or the advantage that we have is technology. We are not a cost leader. We are a technology leader in this segment. We can solve customer problems, and therefore we are participating in areas that we can solve problems for OEM fleet, which is our own supplied equipment. So our own supplied equipment is roughly 6% of the market. So it's not a very big installed fleet of the total market.
Okay.
So that is the OEM fleet, and that OEM fleet we participate. But we also participate on other 50% of the market, which is largely the other OEM fleet, which we call the DHL fleet or the Chinese fleet, where we solve technical problems for the customer, which typically they cannot solve. And we have a competitive advantage. So we are talking about a low double-digit, high single-digit, low double-digit market share in this segment. And we are working on retaining, improving the market share in this consistently in the core segment. On the upgrades, the government has outlaid about 20 gigawatts of upgrade program 60 gigawatts. We think 20 gigawatts would also be excellent, but 60 gigawatts is a total plan. We are maybe thinking even if 20 gigawatt materialize or that 60 gigawatt upgrades are in the plan, that would significantly open opportunities in upgrade. However, most of them are government tenders and they are competitive in nature, and we will see wherever we are able to get margin cash accretive deals with the risk reward ratio is where we will participate. So, but it's the area where we have a technology advantage. And for example, the Denox jobs, we've had a very good strike rate and a good performance in the upgrades.
Sir, on industrial side?
On the industrial side, what we've been focusing on is one, participation in industrial customers. So we have focused a campaign to improve participation in the industrial customers for services. That's one. The second part is the Durgapur factory, where we have capabilities for fabrication, excellent welding-class welding capabilities. And these factory can also support demand from industrial customers like steel, cryogenic oil and gas applications, and pressure vessels. So we did disclose an order in the cryogenic area, in the pressure vessel area, where we had the first order a couple of quarters ago. And that is an area that we think will help us utilize the factory in Durgapur, and it matches the capability that we have. The factory is located in the eastern sector, and therefore we can have a advantage in that sector. That is an area we want to participate. So here, since the factory is underutilized, and we had about 88,000 hours capacity, we have now come down to about 240,000 hours capacity in this factory. So we have a challenge of, and the load currently is in the range of 80 to 100,000 hours. So we have still underutilization of the factory that is hitting our bottom line with underutilization. So the objective here is to add additional industrial business so that we can recover the cost of the factory and eventually turn around the performance of the factory. So that's the focus. And in this area, we will utilize the factory in the areas of pressure vessels, cryogenic area, and also the industry segment.
So coming back to first participant question on generation side, as you said that there is a balance sheet side challenge and working capital. Subject to that, I mean, if the promoter starts, supporting whenever, 3 months, 6 months, or maybe 1 year. So what are the opportunities? Do we have our capability to participate in that? And second, recently there was a news write-up that CEA has, since Indian power requirement from thermal side is huge, but all the large players are fully moved. So Thermex and our company have been allowed to participate. So if you can give some more color.
So I will add the last one before the others. So the qualification of Durgapur as a supplier is being done by the government, and however we don't do EPC in the company. So should we have the backing in future of a promoter on the new build coal, in that case we would need to partner with an EPC to be able to address the market. So at this point we will not be able to participate till the time we solve this challenge. So at this point we will focus in the strategic areas that I have explained previously earlier in the call, which is services, core and upgrades, and brownfield FGD on EP basis, and the industrial areas, and selectively on the hydro PSP opportunities and service. So that's what we will continue to focus, which is irrespective of the promoterization, and that should provide sustainable growth for the company. That is why at this point in time we are very clear on what we will continue to focus on.
Thank you very much and all the best, sir.
Thank you. The next question is from the line of Ramakrishnan V, who is an investor. Please go ahead.
Hello. Yeah, good evening, sir. Thanks for the call. Sir, see, Durgapur, you are mentioning about that 240,000 hours available, and I think 80,000 to 1 lakh hours we have got. So, why this is measured? Is there measured as a capacity? And if we are fully occupied, then what kind of turnover we can get?
It's a good question, and the reason why we don't. So if you see what we've been sharing over the last couple of years, 2 years ago we had less than 10,000 hours of load on services to Durgapur. So we started focusing roughly about a year and a half, 2 years ago on adding services for Durgapur. And that service load has brought in about 100,000 hours from Durgapur. The capacity was 800,000 hours roughly 3-4 years ago, where we were still executing the backlog of all the projects. That backlog has been executed, but there is still very good competence in the factory. And the competence of the factory to be retained, we have come down to a size that is the best that we could do in terms of optimization of the capacity, at the same time that we retain competence. So that is where we are with the size of the factory. And I think this is a good place. We see opportunities that we can retain this competence, and if you are able to bring back the retention bring back the utilization of this capacity to about 150 or 200,000 hours, then we will be able to solve the underutilization hours. The hit of the underutilization, Yogesh, can you help with the number? That is the negative number that we carry on in general books in crores because of lack of utilization of Durgapur. That is the negative number that will go away, and we will see some positive value creation. So what's the number, Yogesh, if you can help me?
The amount of under recovery presently, based on the projections that we are giving, is in the range of about 12 to 14 crores.
Yeah, so overall it's about 40 crores if you don't recover anything from the factory. So that's around 40 crores, and we are working to load and reduce the under recovery to 10 to 13 crores. And if you're able to, so you can see that impact of maybe if we are able to fully recover, that will also go away, and then the margin will start. So that's the journey that we are looking for as we move towards this strategy.
Sir, how many employees are employed in this Durgapur plant? And suppose if you are able to do that fully utilization, what kind of turnover you can get?
See, the issue with the factory, as I said, we do not project, and it's a company policy not to give future projections in terms of revenue. But I explained that Durgapur is not a revenue problem, it is a underutilization and a loss problem today. So we have to solve the negativity, and that is the reason why we don't want to focus on the revenue. That is not what we are chasing. We are chasing the underutilization. We want to come back to capacity, utilize, and then we will take it from there.
Thank you. Mr. Ramakrishnan, may we request that you return to the question queue for follow-up questions. The next question is from the line of Dalip Jain from ICICI Bank. Please go ahead.
Hi, sir. Good evening. Am I audible?
Yes, very good evening. You are.
Sir, my question is with respect to trade receivables. Sir, as of March 2024, we have trade receivables of around 1,699 crores. Sir, how much of these receivables are retention money, and till when this retention money is expected to be realized?
Hello.
Yeah, Yogesh. Sure.
So out of the total that we have, as you mentioned, we have retention of close to 11,700 million, 11.7 billion. So basically 1,017 crores, 1,170 crores is the retention amount. And on the likelihood of realizing or recovering this money, this is linked to the various project milestones that we have. And these are a work in progress, and as and when we are achieving these milestones, these payments are being collected from the respective customers. And the timelines, the indicative timelines that we are looking at is close to about 2 to 3 years to recover these retentions that we have.
Okay, sir. Thank you.
Thank you. The next question is from the line of Lavish from Sushil Finance. Please go ahead.
Hi, sir. You are very positive on power sector. Then why is not parent company infusing money in India? And sir, it has been almost 4 years, 16 quarters. Hello?
Yeah, please go ahead.
Yeah, and it has been almost 4 years, that is close to 16 quarters, but yet the company is not performing well as compared to the power demand, power consumption in India, what we have seen like in 4 years. So, sir, what is your outlook on this?
So as regards the company performance, I have said earlier today in the call, the big issues that we have faced starting from COVID period was project delays as one fundamental major challenge, both in hydro and in steam. In the last 3 years, we have seen significant project delays. And as the projects get delayed, there is a cost update that happens, and therefore we have seen project margin updates. That's one. The second was the significant incidents like the Solapur fire and the Sipak fire. These two incidents alone have roughly costed the company about 150 odd crores. So that is an additional impact that the company has seen. These are the two major reasons why we had an operational impact on the performance. Third, of course, was the lower volume, because COVID period 2 years, there was no major ordering as there was a big lull in the demand. At that time, there was no focus on thermal, and therefore there was much lower order intake. And post the COVID, the government had extended the FGD timeline, and therefore the FGD orders, which were significantly in the order book of the company, did not happen. And therefore, nor did the PSP hydro projects come in as anticipated. And therefore, we have seen consistently for last 3 to 4 years a very significantly lower order intake into the company. That has deteriorated the quality of the balance sheet of the company, and therefore, the focus of the company has been to focus on margin and cash accretive deals. There was also, if you remember, post-COVID, due to the Ukraine crisis, a hyperinflation, which also impacted the material cost. What are we doing about it? We have been reporting quarter on quarter the performance in the 3 areas. That is, one, we wanted to de-risk new build, which is EPC versus non-EPC. That is one lever that we've been reporting every quarter, but you can see that for the last several quarters. Quarter on quarter progress on de-risking EPC versus EP. The second lever that we've been working upon has been to grow services business, and that has been very, very successful with about 40% growth this year in core services that we have reported. And third is the industrial business and getting to private customers for business, which is also helping the company convert slightly better margin cash. So those are the 3 levers. While we do this, still the challenge of the right mix of revenue, cost versus backlog is what is the current challenge of the company, and this is what we need to solve.
Okay. Thank you.
Thank you. The next question is from the line of Himani Shah from Alchemy Capital. Please go ahead.
Hi, can you hear me?
Ma'am, may I request you to use your handset?
Can you hear me now?
Yes, ma'am. Please go ahead.
So just a couple of questions. So firstly, on the BHEL call, they basically said that they would maintain a 30% market share when it comes to FGDs. And you in your previous interaction have mentioned about 10%. So and it, FGD...
Sorry, who said 30%?
BHEL.
BHEL, okay.
And I think you in your interactions in the past have mentioned about 10%, if I'm not mistaken.
Mm-hmm.
So just wanted to understand, how is the competitive landscape, sir? As in, is it because see, a lot of the players may not have been able to, go through this period of stress. So how are you seeing the competitive? While you mentioned that, in that you would be able to, you will only bid for better margins or maintain your margins. But what's your so how are you seeing the competitive landscape standing out? And secondly, sir, thus on the realization front, how competitive are the bids, and Are you seeing any improvement in terms of realization? Because that is something that, we hear from some of the power generators. So just wanted to get your sense on it, sir.
Yeah, thank you. Look, the realization for FGD price, Vineet also mentioned earlier in the call, the prices have gone up, and the government has also acknowledged and noted the prices have gone up. However, this is a regulated market, which means that the regulator has to approve that there has to be a tariff revision, the developer has to be able to pass through the tariff. The developer's balance sheet might also be stressed. They need to get a financial closure, and then they would make an order with us for an FGD or with any other player. So that's one underlying character. This is a regulated market, and there is a long process. Typically, we have seen from the date of ordering to realizing an order, we have seen a year delay. As you would have seen also, Sikka, we were L1, and it literally took almost a year for us to be able to materialize that into an order. So we see that the cycle is slow. It takes time. Now, regarding the 98 gigawatt ordering which is left, there are three categories of customers, which is state, central, and private IPP. The central pretty much is done. It is the state and IPP that are left. State will largely go with EPC, and we will not participate in EPC bids. We will participate if we have the right risk-reward via an EPC player, if we are able to get a right risk-reward ratio to us. So here it will be selective participation. Again, in the IPP customers, which is the private customers, we are again going opportunity by opportunity. So now the number why we are not comfortable in sharing market share is because if there is an ordering in the current year, but it is not of the customer that we would like to deal with, from my point of view, that is not an opportunity for me, but maybe somebody else finds it attractive. Therefore, market share over a period of time, maybe 2-3 years, yes, that makes sense to say 10%, but if I now start doing year on year, it all depends on the mix of ordering from state versus IPP versus EP versus EP that we could have participated in the current year, and therefore it's complex. And that's the only color I wanted to add. And Vineet, maybe you can share what is the split of 98 in state IPP. And,
so if I can just ask another question. So if realizations are improving, then given your costs are already in place, then you would have advantage of cost efficiencies here, right? So then why would you not be able to maintain
I'm sorry, we missed my previous calls. We have been reporting that current structure for the company, we are operating below break-even. Because we have a large project backlog that we are yet executing. These projects have come to the tail end, yet we have a high site activity to collect our retention milestone. Therefore, we need a large structure to execute the project. However, we don't have the backlog to be able to give us a revenue which is break-even. So the break-even revenue for the today's structure of the company is in the range of 2,000 to 2,500 crores. And we are far below that at this point in time, which is a challenge for the company. So even if you book a couple of projects, even today in the previous call when we were talking about the question when we talked about the JP order, we said that, look, the time that we will get this revenue into the books will still take a few quarters. Typically, the peak of the revenue is 12 to 18 months. So even if I book an order today, that will come to the revenue much later. And therefore, for us to get to that break-even revenue with the right cost and the right revenue is going to be several quarters away. And therefore, we have been cautioning or sharing the update that we are working on a strategy with focus areas. However, for us getting sustainable quarter-on-quarter margin will take several quarters.
Thank you. Ms. Himani Shah, may we request that you return to the question queue for follow-up questions?
Sure, okay.
The next question is from the line of P.P. Rajesh from Banyan Capital Advisors. Please go ahead.
Hi, thanks for the opportunity. Most of my questions
may I request that you use your handset, sir?
Yeah, I am actually very close to my handset.
Okay, sir. Your audio is not very clear, sir.
Okay. How is it now?
Yes, sir. It's slightly better. You can go ahead.
So my question was, when you talk about demonetization, does it have any impact on your current order book? You mentioned that you are not able to bid for the new projects because of that issue. but I just wanted some clarification if it impacts your current order book.
On the backlog today, there is no impact because we are committed to execute the backlog and we don't see any challenges in execution of the order. On the backlog, we also don't see any challenge on the strategy that we discussed today. So, no.
Okay, great. And my second question was that in terms of your backlog, how much of it is the slow-moving projects that you referred to earlier on the call?
So, Yogesh, while you get the number, we have these projects from Hydro, the projects from FGD largely as the project backlog. Then we have the upgrade and services in the backlog. And upgrades and services, roughly about 50% of the services backlog we convert in the same year. So we don't really carry a lot of backlog for that. But yeah, we will share roughly the percentages. Yogesh?
Yeah, Prashant, we have one contract which is presently under suspension, which is the Saundati project, which you mentioned about the reason, and we mentioned about the low revenue as well. And we are in discussions with the customer for restarting this contract after all the necessary commercial contractual obligations are taken care of. So this is one of the slow-moving contracts that we have in Hydro.
I'm sorry, I missed the amount. What is the amount of that?
Give me a minute. I will get back to you in a minute. Kalpesh, you are on the call. Kalpesh Shah.
What I would suggest, Yogesh, if you can just give the gist of the project backlog versus non-project backlog. In my view, the project backlog is roughly 60-70% of the backlog.
Very much, Prashant. And the backlog, we have clearly all the visibility on the backlog. And we have, as you very rightly said, the backlog is primarily projects. And the 70% is clearly like the backlog that is coming from FG and Hydro. And we have some backlog from services as well, which is close to 15 to 20%. And this has been the trend in the past also. And if you look at the bifurcation, almost about 50% is coming from Hydro. And Kalpesh is on the call. He can share the value of the Saundati project.
Yep, sure. So the Saundati is around 50 crores. Is one project which we are currently in discussion with the customer.
And the rest of the projects are on track, and they are moving as scheduled and as per the availability of the funds, etc.
So to summarize, about 50% is a slow-moving backlog. Some of that is even slower, like maybe it will start, but that's roughly more than 50% is slow-moving.
Okay, so just to summarize, you're saying that of the total order book, 50% is slow-moving, about 70% is related to the project, and the remainder is on the services side, which generally gets converted into the revenue within the same year. Is that sort of the good understanding of your order?
Yeah, the rest of the 30% is typically in 2 years. Yeah, 1.5 to 18. Services goes max to 18 months to revenue, because that includes upgrades. Yeah.
Thank you so much. That was very clear. Appreciate it. All the best.
Thank you. The next question is from the line of Premal Shah, who's an investor. Please go ahead.
Yeah, good evening, gentlemen. I have a couple of questions. The first is, in this quarter's results, we realized that there is a 79 crore other income. And what is it basically for? Can you just give us a breakup on what kind of other income is this?
So this is coming from claims, the insurance claim and customer claims, pretty much. So that's it's about I would say 75% is coming from the insurance claim, and the rest is customer claims for extension of time and price variation.
Okay.
And there have been some provision write-backs, especially on the delayed export incentive. So we had provided for that, which we have accomplished. So these are the two major, I would say, things contributing to this other income.
Mm-hmm. Okay. And the second one is, sir, in the current order book, probably as on 31st or as on today, what is the percentage of service orders and how many of those are going to be executed in the current year?
I just said that in the previous question. About 70% is project and the 30% is service and industry, of which you can say roughly would take about 15 to 18 months.
15 to 18 months, okay. Mm-hmm. Okay. Thank you. Thank you very much, sir. That's about it.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Prashant Chiranjeevi Jain, Managing Director, for closing comments.
Thank you all for participating. Really appreciate you, and thank you, the team, for answering the questions. Have a good evening.